Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're going to answer the question, can we easily pay off 23,000 in loans under 1 year? Now, for most people, this isn't a really amazing feat, but we've covered this before in our Velocity Banking 101 video, which I'll put a link down to below if you want, in case you want to watch it. But basically, we're reviewing previous materials because how do we learn as human beings? Basically, repetition is the mother of all learning. So we're just going to do a review over and over again until you're able to be confident in what you have learned. So we're going to try to pay off 23,000 loans under 1 year using something called Velocity Bank, right? And I'll just do a quick overview of what Velocity Banking is, the goals, and how to do it. It's really simple. All you have to do is just tweak your behavior, right? So, three goals when I'm trying to pay off debt. So these are the goals for Velocity Banking. Number one is I want to pay it off quickly, right? So I don't want to wait like 100 years to pay off my debt. I want to do it within under a year. Number two is I want to reduce the interest that I would pay. So if I'm paying, let's say, $4,000 in interest on a loan, what's something I could do where I could just pay it off quickly, and then instead of paying 4,000 on interest, I'd pay 1,000, right? And the other thing is that we want to maintain liquidity and control of our money. So what happens when you, let's say, overpay a student loan or overpay a mortgage? You've lost that money. If you overpay, you can't call the lender, the bank, say, "Hey, I accidentally overpaid $500 into the mortgage. Can I get it back?" They'll be like, "No way, can't do that," right? But if there's a way where if I were able to overpay, but still be able to use that money in case of emergencies, then I'm game, right? So next thing, we're just going to do a quick summary of what is this velocity banking technique. It sounds so cool, right? But it's just little tweaks in your behavior. So when you get your paycheck, you're going to put it in this thing called a line of credit. And if you've never heard of line of credit, it's basically a financial tool where you take out money or you could borrow money, repay it back, and then borrow it again whenever you want. So a credit card is a line of credit. I'm sure most of you have a credit card, right? So other types of lines of credit are personal lines of credit, business lines of credit, home equity line of credit. And so you put your entire paycheck, you take out your expenses out of the line of credit, or yeah, so put your entire paycheck into a line of credit, take out your expenses out of line of credit, and then just repeat, rinse and repeat over and over again. And you'd be like, is it really that simple? It kind of is, but it's kind of not because like it's kind of easy, but most of the population is just kind of living paycheck to paycheck because they just don't know how to make little tweaks in their behavior to be able to pay off the debt quickly. And a lot of people are drowning. So let's go back here. So I got my spreadsheet. Again, we're trying to answer a question. Can we easily pay off 23,000 loans under 1 year, right? So first thing we got to do is create a budget so we know where our money's going. I'll say this is the average American. So let's say we just have $5,000 paycheck every month, $3,000 savings, 2,000, I'm sorry, $3,000 in expenses, $2,000 in savings, and then we'll say $0 in cash flow. So the difference between savings and cash flow is very nuanced. It's very similar, but the reason why we kind of differentiate is because savings are meant to be parked and not to be used maybe only in emergencies, right? So just be aware of that. Okay, now after we have our expenses, then we're just going to do an expense breakdown. So here we have an expense breakdown of student loans, car loans, rent, other, right? But what's really important when we do this is that every single debt that we have must be its own line item. So we can't combine the student and car loans together. You have to make sure that they're a separate line item. But these other things like rent, food, gas, we can actually combine if we wanted to. Now, the reason why it's separated or it has to be a separate line item is because we have to see how much cash flow is being eaten up by this debt because every debt represents a cash flow taken away from us, and when we pay off that debt, that represents cash flow recovered. Okay, and you'll see what I mean by that. So I have our expenses. So we got that. Now we have a second step. We need our tool, and our main Velocity banking account operating tool is what we call a line of credit. So in this example, let's say that I was able to go to maybe like a local credit union or a local bank and say, hey, I'd like to borrow $25,000. It's kind of like having a $25,000 credit card limit, but instead of a credit card, it'll be called a personal line of credit. So it's very similar, although there's some nuanced differences. And the bank says, okay, we'll charge you 15% for the money, and it'll be 25,000. You can borrow up to 25,000. And you're like, dude, that's cool, right? So let's see what happens when we have the tool and we have the budget, right? So question to you all is, what's an easy way where I can kind of decrease my expenses by $1,000 with just one little tweak? Like I just do one little thing, and then I can like, it's almost like getting more income, but not really, right? What's an easy way for me to decrease my expenses by $1,000? And I'll show you how. All you have to do is just move these two loans to the line of credit. So, right? So how much are these two loans? The student and the car loan, it's 23,000 in total, right? And so if we move this 23,000 in total to that credit limit, because the credit line allows us just easily just pay off any debt because it's like cash into your checking account, and then we just pay off those two loans, and then we're being charged 15% interest. All we do is just a simple debt transfer, right? So now what happens? We pay off these loans. I'm going to strike these out. And then what happens is that our expenses magically just go to $2,000, right? $2,000. So we have the same income. Our expenses now are $2,000. We're going to do something a little bit different. We're not going to have savings anymore, right? Savings is idle money. The bank's making 6% on your loan or every payment, charging you 6%, but they're giving you 0.001% savings. No thanks. What we want to do is put our entire paycheck into the line of credit. So whatever was our potential savings is going to be used to bring down the balance of the loan. And we call that cash flow, right? So basically all we have to do is just take paycheck minus expenses, and that will be our cash flow. So C2 minus C3, and our cash flow is now 3,000. So it's almost like when we did this debt transfer, we got almost recovered $1,000 out of thin air really easily, right? So now what we do is the strategy is you put your paycheck here, so 23,000 minus 5,000. Eventually your expenses are going to come out here. So eventually that'll be 18,000. You get the 2,000, you charge $2,000 to your line of credit, and then the next month's balance will be approximately 20,000. So I'm not 20,000. Yeah, it is going to be 20,000. So now what you do is, the easy way to calculate this is just get your balance and then subtract it by your cash flow every month. So here I'm going to do that. So simple formula, H2 minus 3,000, right? So if we just rinse and repeat over and again, we're able to see how long it will take us to pay off the debt. And we'll say that the first month is month 0. When we did the debt transfer, this will be month 1, 2, 3, 4, 5, 6, 7. So it took us about 7 months, which is under a year, to pay off the debt. And it was really easy. All we have to do was just get a line of credit, do a debt transfer. We free up an extra $1,000, and then after every month, the balance of the line of credit will go down, and we pay it off in about 7 months. Now, when you use other people's money, is it free? No, that's why we have the interest rate here. So what we can do is calculate how much interest we're paying off in the approximately 7 months, right? So what we do is we just take the previous month's balance, multiply it by the interest rate, and then divide it by 12. Now, why do we divide by 12? Because these interest rates are quoted annually, and we're going to take the monthly interest. So that's how that interest is calculated. It's still an approximation because the bank actually, or the lender actually, calculates the average daily balance, but monthly is good enough. So here's how we're going to calculate the interest. So we take the balance, 23,000. Well, let me just do this. H2, which is the previous month's balance, multiply by the interest rate, which is 0.15, and then divide by 12. Always make sure you divide by 12. And then we're going to copy and paste that formula. And now we're just going to go ahead and sum it up. If you want an easy way to sum up, just click this auto sum button right here, and the system will do it for you. And now you've paid $1,200 in interest, or 2050 in interest. We paid that under 7 months, and we didn't really change much. We certainly didn't make any more income, right? We certainly did not make any more income. And so now, basically, since this debt is paid off, now we're just going to have, every month $3,000 of savings in our savings account, right? So now let's just do a quick review one more time. So did we pay off the debt quickly? Yes. Did we reduce the interest? If you do the actual calculation, a little bit more complicated, especially when you're dealing with like loan payments and how the amount of interest is calculated. But if you do it and do it in detail, then the answer will be yes. But if you see here, when we did it this way, even though it's 15%, we only paid about $1,200, right? So wow, $1,200, 7 months, even though it's quote 15% interest, which seems like a lot, we didn't really pay that much. Next one, maintain liquidity or control of your money. So were we able to do this? So I'm going to explain what I mean by that. So let's say here, we're in this average American scenario where we're just paying things out of our checking account, right? And so we have this $2,000 in savings, and let me unstrike this. So let's say that we have these $2,000 in savings, and then we overpay the student loan, right, and this car loan more than the monthly payment amount, right? So I'm just going to pay the monthly payment, but I'm saying, hey, you know what? I want to actually put all my savings to here and here. Maybe I'll spread it out where, $1,000 I'll pay extra into the car loan and $1,000 I'll pay extra into the student loan. What happens? You lose your liquidity, right? You lose your liquidity. And if you ever needed that money in emergency because you overpaid, yeah, you certainly save money, but you can't ever get that money back. You call the lender like, hey, I accidentally overpaid $1,000 to a car loan. Can I get it back? I need, $10 for more groceries. They're like, no, you're good. That's what they'll say. However, when we're using the line of credit, let's say I'm in month 2, I have up to $5,000 in emergency funds. And then as I progress through the months, let's say here, I need an extra $50. Even though I'm overpaying, I still have liquidity and can maintain control of my money. It's not a big deal. But when we overpay with our savings directly to the loans, and we need an extra $10, so let's say like, I paid $2,000 into my car loan. Whoops, I forgot to buy onions at the grocery stores, or a few other things, and I need extra $10. I'm screwed. You see what I'm saying? So when we do it this method, we free up an extra $1,000 in cash flow, and we maintain control and liquidity of our money. Any of these months here, I could just access an extra $50, $100, $200 in case I happen to need it. Yeah, sure, it will delay the payoff, but I'm able to sleep at night. Whereas if I overpay the loan, I can't sleep at night. And that's why most people, they know that they can save money just by overpaying the loan, but they ain't going to sleep well at night because the liquidity is gone. All right. So what do you think? Did we easily pay off this $23,000 in loans under 1 year? I think we did. But here's the thing. I'm going to repeat doing this over and over again in other videos. So go ahead and make sure that you subscribe to this channel to keep up, to view any updates. And also, if you're interested in joining our group, go ahead and click the Google Form link below, or you could email us by finding out our email address in the About section of our YouTube page. All right. So I hope we answered this question. I hope you're satisfied, and maybe you'll be able to apply some of the ideas in this video, because I certainly did in my life, right? And because I did this exercise thousands of times, again, repetition is the mother of all learning, and I feel like I'm a velocity banking master. Maybe not. All right, so this is Korean Atlanta Mentorship. Have a great day, and we will speak next time.